This is level 1 of the CFA program, the topic on corporate issuers, and the reading as an introduction to corporate governance and other ESG considerations. I want to do two quick things before we get to the actual slide deck. One on corporate governance, one on ESG considerations. Let me give you just a quick idea about how businesses work. This is what we know from our capital structure and our capital budgeting readings. We know that businesses, they regularly borrow money, right? They do it on the top right of the balance sheet, either through a bank loan or a bond issue. And they do it from the bottom right of the balance sheet through an equity issue. And so these firms raise huge amounts of capital. They transfer that capital over to the left side of the balance sheet. Of course, it's cash for just a short time period. And then that cash gets invested into long-term assets that are going to generate the product lines of the company. And so corporate governance is really a system. You know, it's basically an economic system and an operations system and a management system. But corporate governance at its core is really a leadership system in which individuals and groups of individuals are responsible for what goes on the balance sheet and then over on the income statement and then on the statement of cash flows. And when I say responsible for, I want to give you a little bit of an historical context. In the old days, that responsibility was, you know what, we have lots of people that are involved in our company. Let's make sure that we don't upset them. And so that was like the beginning of corporate governance, you know, maybe in the 70s and the 80s. But then, you know, during the late 80s, this really got some steam behind it. And there was a shift in the emphasis from let's not really upset all these people, but let's go ahead and satisfy them. Let's satisfy all of our stakeholders, including employees, including those people along the supply chain, including government representatives and officials. And we'll talk about that as we get through the slide deck. So I want you to think of corporate governance as a leadership issue to focus on the core competencies of the business, and then or B, how does the business do this by satisfying all of the involved people. Now, the second thing I want to do is I want to just mention these other ESG considerations and how the CFA Institute has approached this in recent years. I want to hold up, can you guys see this? I want to hold up the winter 2021 issue of the Financial Analyst Journal. And by the way, I love reading this when it comes out. And I do read it, and I read it to my students. But can you read this first article right here? I need to take my glasses off. Environmental, social, and government issues and the Financial Analyst Journal. So this is the lead article in their 2021 winter edition of this journal. In addition, you can go to the CFA Institute webpage, and you can see that they are now awarding a certificate in ESG investing. And so I mention this just because this is a rising topic of importance. And I imagine the CFA Institute, since they're attaching such import to this, is probably looking to ask some really, really super exam questions. And you'll see that as we go through these learning outcome statements. So corporate governance, so we defined that almost already. Stakeholder groups, I did that. We need to talk about the agency conflict, which leads right into stakeholder management. And then look at that last one, functions and responsibilities of the company's board of directors. This is what I tell my students all the time. It's the job of the board. Now, of course, the board does many, many things. You'll see that on a slide, but essentially it's the board's job to hire and fire the leadership team. And the hiring and the firing of the leadership team implies all of these best practices of corporate governance that we're going to cover. Potential risks analysis, and then the last couple we get into the ESG investing. So let's go ahead and start with a description of corporate governance. What did I say earlier? It's probably an economic system. You know, it's probably an operations system. It's probably a management system, but it's in general a leadership system of internal controls, processes, and procedures in which a company is managed, directed, or controlled. All right, so that makes perfect sense, and it makes extra sense to see our second point there, rights, roles, and responsibilities. So that third arrow point there probably is a point of great exam testing. Goal of corporate governance: promote the interests of stakeholders in a fair and transparent manner. So notice that this should not be in conflict with the goal of the business, which is to maximize shareholder wealth. And of course, we go back to the great Milton Friedman in the late 60s and early 70s when he pretty much formalized this goal of the business. And I teach my students this all the time. I regularly say, look, the goal of the business, of any business, is to maximize the value of the assets to the owners. But there's not a period. There's a comma at the end of that sentence. And after the comma, it reads something like, as long as all of the rules and responsibilities and legal issues and ethical issues are followed. And so that second part of Milton Friedman's goal is really what corporate governance is all about. Let me give you a quick example. If you go to the Johnson & Johnson webpage, you can link to Principles of Corporate Governance. And there are pictures of its board members. I think J&J is up to 12 or 13 board members. All of them are independent board members, meaning that they work outside of Johnson & Johnson, with the exception of the CEO as of 2021. Description of the management team as well and all of their roles and responsibilities. But I thought this was super interesting. There's a link down there that says something like, look, if you buy one of their products and you don't like it, you can write to them. There's a description of how to write a letter to the board. And you can say, dear Mr. and Mrs. Board Member, this thing doesn't work like it said it was supposed to. All right, how about a description of stakeholder groups? So what did Milton Friedman teach us? Maximize shareholder wealth, comma, and let's figure out what we can do with all of these other groups and individuals. So here, primary stakeholders. Of course, let's go ahead and look on the right-hand side of the balance sheet. The owners, right? The shareholders, right? What do shareholders do? As a shareholder, you have a claim on the earnings stream of the business. And of course, out of that earnings stream, the board can pay you a dividend, or you can go to the New York Stock Exchange or any exchange out there and you can buy low and sell high. So the owners of a business, they get two things. They get dividends and they get expected capital gains. But of course, clearly there can be capital losses as well. So moving up then on the right-hand side of the balance sheet, this is what I said earlier, banks and bondholders and then general creditors. So those two groups have been well represented in historical finance and economic and accounting research. But this idea of best practices in corporate governance then has expanded to include other stakeholders, which includes middle management and the employees. It includes suppliers. And as of 2021, we're keenly aware after COVID, not that COVID is over, but after the big hit of COVID, that there are supply chain issues. And so suppliers here, I want you to make sure that you're thinking about both sides of the supply chain, because these people are, and these groups and these individuals are important stakeholders. And then board of directors there, and then some others, customers. So that's both sides of the supply chain, governments and regulators as well. How about a description of the principal agent problem? Well, corporations are described by, publicly held corporations are described by a dispersion of ownership, which means that large companies like Johnson & Johnson have, billions of outstanding shares, which means that the owners of Johnson & Johnson are not right over here in our backyard, right? They're over there and at the North Pole and all over the place. However, the decision-making power rests with the executive leadership team and then, of course, through the board of directors. And so we have this relationship between the principals and the agents. And so the agents are the executives that make capital budgeting and capital structure and dividend policy decisions. And of course, the board of directors hires these top executives as stewards of the bondholders and the shareholders' capital. And so the goal of the business is to, do I have to say it again, maximize shareholder wealth, comma, and all that other stuff that I just said. However, there is a conflict. The principals might not have the same goals as the agents. And so there's an example we have: hiring a contractor to finish the kitchen or hiring a lawyer. We see this on television all the time with all of the cases being brought to us. Now we can watch them live. And then, of course, those of you who have remodeled your kitchen or your bathroom or any part of your house, you know that contractors have some incentive to cut costs, especially in areas where it's not quite as obvious. So look at that third circle point. The agent may have an incentive to promote their own interests at the expense of the principal. So let's take a look at some examples of principal-agent problems. And here's the most obvious one between the shareholders and the managers. So shareholders expect the executives to make capital budgeting decisions that are going to maximize operating cash flows over the long term, right? Think Milton Hershey. What does Milton Hershey do every day? Milton gets up and he says, let's make some Hershey chocolate bars. And what do we know if we're shareholders of the Hershey company? We know that Milton Hershey makes great chocolate bars, and that people demand those chocolate bars, and that Milton Hershey can sell those next week and next month and probably 10 years from now and probably 100 years from now. Managers, on the other hand, they have an incentive to maximize their own personal wealth. This is called an expropriation of resources. Now, the idea behind that managers want to maximize their own personal wealth goes way, way back to a couple hundred years ago to Adam Smith. Adam Smith was a world-famous economist who came up with that idea of the invisible hand. Can you see my hand going to the camera? Well, if you can see it, it's not invisible. However, what Adam Smith suggested was that all of these self-interested, how about if I even call them selfish individuals who are meeting in a marketplace to trade, these individuals acting in their own self-interest, what they do is that they arrive at an agreeable market clearing price that benefits us all. And that's really the basis of that old-time movie in the 1980s, Greed is Good. Now, I'm not quite sure that Michael Douglas meant it in the Adam Smith sense, but nevertheless, think about this. If I'm an apple farmer and I have a beautiful Honeycrisp apple, and I say to you, oh, this is the greatest apple that ever lived, I'll sell it to you for $10. And you may look at me and scratch your head and say, wait a minute, Jim, $10 for that apple? I mean, it's a great apple, but $10 sounds like too much. I'll give you $3 for it. So we go back and forth, right? What do you want? You want me just to give it to you for free. What do I want? I want you to pay me thousands of dollars for this apple. We're both selfish, but we arrive at a market clearing price. Let's just suppose it's $5. Then everybody else can come in and benefit from our transaction. Now, Milton Friedman, notice I have a year 1970 there. It was around 1970. He came up with this formalization of shareholder wealth maximization, which I was talking about in of course, the introduction. And so note, there's a natural battle between executives saying something like, hey, we want our own self-interest. We want our stuff, versus their responsibility as stewards of the capital provided to them by the bondholders and the shareholders. So this is a natural conflict. I tell my students this all the time. A natural battle between the leadership team and the shareholders. And this is evidenced by the consumption of these perquisites. You guys probably know this in its shorter term as a perk. Right? What do executives want to do? They want to have beautiful offices. They want to have nice furniture and paintings on the walls. They want to have bonuses. They want to have a limousine service drive them back and forth to work. They want to have access to a company helicopter and an airplane and maybe a space shuttle and all sorts of company perks. Now, it's up to the board of directors to decide which of those perks is acceptable or unacceptable. I'll give you the quick example that I give my students all the time. I say to them, all right, you guys are shareholders. I'm an executive in a company. And I say, you know what? I think you guys ought to pay for my membership up at the country club. And let's suppose the country club costs $50,000 to join, and it's a $1,000 a month fee. So you add that, you get $62,000 for that first year of the membership, I ask my students, I say, do you agree? Do you want to pay for my personal membership at the country club? And I get the students to go like this. And then I give them the example. I say, wait a minute, what if I bring customers and clients from both sides of the supply chain into the country club, and we play golf and tennis and swimming, and we have lobster and steak, and at the end of the day, all of these people say, you know what, this is a great company, we'll take $1 million of whatever it is you're offering. And so if I can bring in, what did I say, $62,000, if I can bring in $63,000 worth of operating cash flows during the course of the year, then of course it's worth it. So it's the board of directors' responsibility to monitor this conflict, and they do this through hiring and firing the executives. All right, that sounds like a great exam question to me. The second one might even be better there. Shareholders, of course, shareholders want riskier projects. Managers, they probably don't want those risky projects, because if they invest in risky projects, even if they have positive net present values, but maybe they have high standard deviations, those managers are putting their job security at risk. And so managers might prefer low risk projects. Shareholders might prefer high risk projects. So that's the second one there. That second one I think is an even better exam question. How about the difference between controlling and minority shareholders? I tell my students this all the time. I say, look, suppose that you guys, you're the controlling shareholders. You own greater than 50% of the outstanding shares. Let's suppose it's 75%. And here I am, I'm a minority shareholder, and I own, let's say, 11% of the company. And I come to you and I say something like, boy, I don't like this and this and this and this. The students look at me and they go, oh yeah, Jim, we're going to just totally ignore what you have to say because we are the controlling shareholder. So we need to make certain, as good best practices in corporate governance, that minority shareholders are heard. Notice our last sentence there, the silence, we put that in quotation marks. Yeah, that's not good. How about managers versus the board of directors? So what happens at meetings during the course of the year? The leadership team comes in and presents a summary of the activities over the last month or 3 months, whatever it is. And so the managers may have an incentive to kind of sugarcoat their performance. They might say, oh, we have a problem over here, but it's taken care of, give them the thumbs up. However, if that problem is not taken care of, then sooner or later that's going to show up on the quarterly report on the income statement, where net income might be lower, and of course on the cash flow statement where operating cash flows might be lower. So look at that. That's information asymmetry. We may have, as executives, more information about the quality of the assets, and we may want to keep that from the board, because what's their job? Hire and fire us. If we continue to have problems over there, boy, we may get fired. Shareholders and creditors. This is similar to what I said on the previous slide. Bondholders and bankers and general creditors, what do they want? If you ask these groups of people, they would say, oh, we want you to invest in low-risk projects so that we can receive our fixed interest and principal payments. But shareholders probably prefer high-risk projects because they want to capture the right tail of the distribution. The reading ends with just a minor description of some other stakeholder conflicts: customers and shareholders, customers and suppliers, shareholders and governments. Of course, governments are going to show up in here sooner or later. But how about a description of stakeholder management? Now, when we get into risk readings, I'm going to say this to you, that it's the job of the chief risk officer to identify the risks, to quantify the risks, and to manage the risk. And so that model over in risk management is pretty much what this stakeholder management is, right? Identify, prioritize. It's super hard to quantify the agency conflict, right? You can say something like, all right, well, Jim, we're paying $62,000 for him to join the country club, and we think he's generating $63,000 in operating cash flows because of this relationship between and among these different groups of people. But it might be kind of hard to actually come up with that $63,000 number. And so, of course, we're going to try to quantify as best we can. That's why the CFA Institute asked you guys to put together all of those counting things and numbers and all that in the early readings. So we're going to quantify, but then we're going to prioritize and then understand each stakeholder group. That makes perfect sense, right? So how about components? Well-established legal infrastructure, yes, contractual infrastructure. Remember, we have to go back lots and lots of years for countries all over the world to look at their history to see exactly how they handle contracts and the enforcement of these contracts. And so a key component here is, for example, if I'm the executive and you guys are my board members, you're probably going to have something in my contract that says Jim is not allowed to do this and this and this. I may have given you this example in previous slide decks, but I think it's worth repeating because those of you who are sports fans will appreciate this. You know, Patrick Mahomes signed a huge contract during the summer of 2020 or 2021, $500 million. And in his contract, there were sentences that said something like, Patrick is not allowed to go skateboarding, or he's not allowed to go snorkeling, or he's not allowed to do this and that. In fact, I think Patrick has been quoted as saying, I'm not allowed to do hardly anything because there's a risk, right? If he breaks his arm, heaven forbid, falling on a skateboard, then he can't throw touchdown passes on Sunday. Well, the same is true for executives. Executives have to understand the best practices of the firm, right? And so they need to act in a professional manner. Go back to all of what the CFA Institute has us learn under ethics and professional considerations and professional reputation and all that good stuff. How about mechanisms to manage all of these relationships? And notice the second part of this LOS, mitigate associated risks. And so I think this is a great exam question where in the question stem, you'll get some description of one of these bullet points. And the question will be, how do you manage this kind of risk, or how do you lessen it or mitigate it? All right, so we have these annual meetings, bringing shareholders and management together. My mother, when she was alive, used to love to get her proxy statements. And she would say, look, Jimmy, I'm invited to the annual meeting in Cincinnati, Ohio. And I was like, Mom, if you want to go, I'm happy to take you. And you can vote your 10 shares however you want. And she would say, you know what, it would be exciting to go there. But we never did. And I wish that I would have done that with my mom. All right, board of directors. Look at what we have written there. Bears the ultimate responsibility over all of this stuff. So that's super important that the board nominating committee does all of its vetting for potential board members so that we bring in, are you ready for this? We bring in highly skilled board members who have areas of expertise and then experience in all different forms and histories and backgrounds and walks of life. Once again, if you go look at the picture of the board members for Johnson & Johnson, and you don't read anything about these individuals, you'll probably say something like, you know what, I want to read about these people because they're probably super smart. And it turns out that they are. All right, the audit function, this is what I was talking about just a little bit earlier. Independently review these policies. So independent, so that's important to remember. That sounds like a great question. You wouldn't want to have, as part of the audit function or on the audit committee, you wouldn't want to have an executive who's making decisions over here and maybe trying to hide some of his or her poor decisions. Reporting and transparency, that's obvious. Policies on related party transactions. This is super important, especially in the age of COVID, where we're relying on all of these remote kinds of transactions, which increases our relationship between and among lots and lots of additional third parties. And so that brings up extra risks. So what did I say earlier? Identify the risks and quantify those risks. And then payment policies, of course, if you look in the contracts of these executives, it'll say something like, you know what, we'll give you a bonus if you do this and this and this. Or, hey, if our stock price goes up by this amount, we'll have some stock options that'll become valuable. And then, of course, one of the recent improvements to corporate governance structure is to have some kind of a system where other stakeholders can have a say in the evaluation of the executives and then on their performance. Here we go. I don't even need to put this slide up, right? What's function and responsibility of board of directors? Hire and fire the executives. But let's go through some of the critical elements that lead up to those ultimate decisions. Provide oversight. That makes sense. A link between shareholders and manager. That makes perfect sense. Ultimate responsibility. And here's that second part of the comma after Milton Friedman's maximize shareholder wealth. Complies with all applicable laws and regulations. And I'm going to go ahead and add another comma there and say something like applicable laws and regulations, as well as an ethical and a moral commitment to all of the stakeholders and comma, perhaps even society at large. All right, duty of care, duty of loyalty. This makes perfect sense, right? Board must be fully informed, due diligence, members to act in the interest in the company and avoid conflicts of interest. And remember, back in our first couple of readings in level 1, boy, not only do we have to avoid the conflicts of interest, we should probably avoid the appearance of a conflict of interest. Let me give you guys a brief history lesson. I wonder if you even know this story about a product recall. Back when I was in high school, yep, this is a super long time ago, there was a terrible tragedy where some individual went into some grocery stores and unscrewed the top of a Tylenol. And in those days, Tylenol had those caplets where you could pull it apart. And those little balls would fall out. And this individual put cyanide in there, and a handful of people, died from this. And, what did Tylenol do? Tylenol, of course, they recalled immediately. And as a result of this, there was the innovation of those plastic sealed containers that you get on top of any kind of medicine and almost any kind of a product that you buy now. So that goes back to Tylenol, 1977. And so Tylenol still around today, right? But they could have gone bankrupt if they would not have handled this properly. All right, this is a great question. Specific duties of the board. All right, the strategy, right? So think of the umbrella. The board members get together, these smart men and women, and they say something like, hey, you know what? I think we should do this, or I think we should do that. And so the board members who have great expertise in all sorts of areas decide if that's a direction to which the firm wants to go. And then what it says to the senior leadership team, all right, this is what we're going to do. You guys figure out the best way to do it, right? We're paying you all this money. And need I remind you, you have a country club membership up there. So use that country club membership to implement our strategy. And then, of course, review performance, determine relevant course of action, hires and fires. I had to throw that one in there. Ensure leadership continuity. Yeah, this is important. And I'll give you the example of McDonald's. We'll look at McDonald's here in just a second. Do a quick search for McDonald's and CEOs if you're not up to date on this. Through, let's say, year 2021, they've had some issues with their CEOs over the last handful of years, and so it's important for the committees inside of the board to plan for when the CEO is going to retire and other key executives. Now, this is not like a nagging strategy. Like if my father were on the committee, every day he would go up to the CEO and say, look, we really love what you're doing. Please stay, but when are you going to leave? So it's not really a nagging, but it's an overall strategy. And then overall structure, right, and reports on the internal audit. That makes sense. All right, so how about some board of director committees? And let me go back and remind you that Johnson & Johnson board is made up of all members that are independent. And so all of the committees are independent, unless, of course, the CEO sits on that particular committee. So an audit committee does exactly what you would think it does to hire and fire the independent external auditor. Think of the Enron example there. Governance committee. So this is important. Implementation of sound governance practices. All the items that we have talked about in this slide deck. Compensation committee, nominating committee. We talked about those things. How about a risk committee? One of the things that has come out of the 2008 financial crisis. And it wasn't just because of the crisis. I mean, this was a movement that started, maybe in the late 1990s and the early 2000s. Most of these companies now have a chief risk officer, and it's the chief risk officer's responsibility to install a risk culture throughout the organization. And this doesn't mean just having a conversation at the board meetings. It doesn't mean just having a conversation between and among the senior leadership, but it involves this seeping down through all of the individuals and the organization units inside of the business. Think of a large commercial bank that has all these different silos, right? There's wealth management, there's retail banking, and there's retirement and insurance, and all these kind of different silos. And so, of course, you have individuals and groups of individuals in each one of these silos who knows clearly the risk of retail banking, which is completely different than the risk of wealth management, right? So there is a risk committee. So there's a chief risk officer who is responsible for, are you ready for this? This is how cool this gets. Understanding the individual risks of each silo and then seeing how those risks vary between and among the different silos. How about if I call this covariance or correlation coefficient, or maybe in the extreme case, a copula. And so risk committee, implementation of a robust risk management framework. So when you get to a question on the exam, think of a commercial bank and all of these different silos. And I bet the answer pops into your head. And then the investment committee, viability of investment projects proposed by the management. And so think of all the ideas that the executives come up with. Are you guys old enough to have watched Seinfeld? Do you remember Kramer came up with this idea to form a rubber lining inside of an oil tanker so that if the oil tanker ever crashes, the oil doesn't spill out, right? This is all part of what we'll talk here in just a few minutes about pollution and safety and all that kind of stuff. Now, that sounds like a great idea, but it's up to the board to decide, okay, how much does this thing going to cost? And B, is it even going to work? Those of you who watch Seinfeld know that Kramer comes up with all these nutty ideas, so it's probably not going to work, but it's up to the board to decide whether or not these capital budgeting projects are worthwhile. All right, how about market and non-market factors that can affect these relationships? So shareholder engagement. This is a huge movement that began, somewhere in the late 80s and the early 90s, and shareholder activism. Notice there's in parentheses there are two words, poison pills. I do want to give you just a quick personal story here. I wrote my dissertation with a professor who was very interested in all this stuff. And he, after we talked for a while, he agreed to be my dissertation chairman. And he said, you know what, Jim, what I want you to do is I want you to write a dissertation that's titled 3 Essays in Corporate Governance. And I thought, okay, that sounds like a cool idea. But I ended up writing 3 dissertations, but it was okay. But a third of my dissertation was on composition of board of directors, and a third of it was on poison pills. And so what I learned back in my dissertation, among all the things that I learned, was that shareholder engagement, shareholder activism, especially as it applies to takeovers and the acquisition market, can be an important thrust to help executives and boards of directors to arrive at the decision. What's the decision? Maximize shareholder wealth, as long as we act ethically and legally, et cetera, et cetera. That's your homework assignment. Go do a search for Jim's dissertation and read it. All right, how about non-market factors? Of course, I said this earlier, the legal environment. This comes straight out of the history of all the different countries, but we can trace it back to the formalization of Milton Friedman. And then look at that second one here. I don't even know what to say about the second one, the media. So fast flow of information, right? So we can read the Wall Street Journal, we can turn on the television, we can look at our phone. But it's up to us as good financial analysts to evaluate the information, look at the source, and try to figure out if it's reasonable or not. So we need to be concerned about what's that term these days? Misinformation. So we need to make sure that shareholders are informed, right? Transparency and all that, but it has to be accurate information. And then look at that third point down there. Unlike in the past, which I've given you a handful of examples, when governance was merely a textbook concept, what did I say earlier? We're trying not to upset those people way over there. And even if we do upset them, we could probably placate them fairly quickly. Now, what is that written there? This is taken right out of the reading. Fully integrated into the company's leadership models. So what did I say earlier? Right. This is a leadership system of corporate governance. I did warn you a few slides ago, we would take a quick look at McDonald's corporate governance fact sheet. Size of the board, number of independent directors, so 10 out of 11. So that sounds an awful lot like these 10 people are probably experts in their fields. Annual review, yes, separate, independent. So notice independent, all the way down the left-hand column. McDonald's has yeses next to all of those. Let me call your attention to the number of board meetings, 8. That's fairly standard. As part of my dissertation, I went and examined the number of board meetings and the number of board members, and it was all over the map. So this, going back to that previous slide, shareholder engagement, shareholders ought to demand that board members meet more regularly, right? That makes perfect sense. Potential risks of poor corporate governance. So this sounds like a great question. In the STEM, as you're reading it, somewhere you'll say something like, poor corporate governance. And then the question down here is, what are some of the risks or the consequences? All right, so fosters unfairness. That should make sense based on all what we've done. But here, I like the second one. This is the one that really stands out to me, making poor investment decisions. So what's the goal of the business? Maximize shareholder wealth. How do we do that? We invest in projects that have positive net present values. Well, if the executives are making choices that result in negative net present values, then this can't be good for anybody. Of course, what did I say earlier? Identify, quantify, and manage the risks. If we have poor corporate governance procedures, then we're not going to be able to adequately identify, quantify, and manage the risks, which means we're going to have risks to which we are unaware. And then all of a sudden, when it's least expected, they are going to bubble out of the ground and hit us right over the top of the head. And then, of course, I'm always a big Modigliani and Miller fan. We'll talk at length about their capital structure ideas. And so I'm always interested in how is this going to affect the bondholders? And is it going to lead us to bankruptcy? Now, the flip side of that is, why are we doing all this stuff? And so here, let me go back here quickly. These are all the downsides. Well, then the upsides have to be kind of the opposite, right? Improved operational efficiency, enhanced control system. Oh my gosh, financial performance, reduced business and investment risk. Those sound like beautiful advantages of having a complete corporate governance structure. How about factors that are relevant to corporate governance? So economic ownership and voting control. So what did I say in one of those earlier slides? These large corporations are described and characterized as separation of ownership and control. So notice what we have in parentheses there. More separation equals more risk. This can be mitigated or attained by giving shareholders certain kinds of rights and a voice in the crucial decision-making process, which goes back to shareholders' engagement. Board of director representation. Well, this is an obvious notion here. A dynamic board membership is desirable if the firm is to actualize effective governance, right? You say, okay, Jim, that's an obvious statement. I didn't need to read that. Yeah, compensation of executives ought to be a reflection of performance, and it ought to be a reflection of current performance and also expected performance. So the executives are evaluated, and the executive, I mean, I could come to you if you're my board and I could say, hey, look, I invested in this great positive net present value project 4 years ago and it's still paying off. And you're going to say, hey, you know what, Jim, that was awesome, but we paid you 4 years ago, didn't we? And we paid you 3 years ago. The question has to arise, what have you done for me lately? Right? Wasn't that a great Janet Jackson song? You guys even old enough to know Janet Jackson was a super pop star in the olden days. Strength of shareholder rights. This is all part of my dissertation, right? Company strong, weak, or average. So once again, we're going to throw this part of a benchmark into the question stem where our rights are strong or weak or, kind of identical to what the benchmark is. So it's part of a job of the board and that chief risk officer and the corporate governance people to decide, who is the benchmark out there? Who do we want to aspire to be like? This is a perfect example of, here we are. And there's always somebody out there who's better, right? There always is somebody who's better. Unless, oh my gosh, dare I say this? Unless you're Tom Brady, right? Oh, I know I could upset lots and lots of people out there who don't like Tom Brady, but I know he's pretty much considered the greatest of all time. So unless you're Tom Brady, and let's just assume and try to be humble, we're not Tom Brady. There's others out there, and there's best practices, and there's a system. So, how do we determine where we fit? Management of long-term risk. This goes right back to how I introduced this concept of the chief risk officer and identifying, quantifying, and managing. Investor behavior, limit or enhance this process. So shareholder activism, I bet those of you who read the Wall Street Journal will know that there are some shareholder activists who are out there and they're just trying to cause problems. They're saying, look, we don't like this, rah. And that's probably not the best way to go about it. And so notice that last sentence, shareholder activism can also create substantial turnover in the company's shareholder composition. So there's a good consequence. Let's move on to the final handful of LOSs that relate to ESG that I referred to at the beginning of the slide deck here. So it's worth repeating. Milton Friedman, what did he say? Maximize shareholder wealth, comma. So the CFA Institute now is identifying a more complete sentence after that comma. Practice of considering environmental, social, and governance factors in the investment process. And then, wow, this can be implemented across all asset classes, including the traditional equity and fixed income, but also including alternative investments. So I want you to think about this as the second part of the maximize shareholder wealth. And I'm not saying it's the second part because it's less important. I'm just saying it's the second part because the goal of the business is to maximize shareholder wealth, right? That's why the shareholders and the bondholders provided capital. But then the comma, I'm going to go ahead and say this is equally important. And the CFA Institute clearly has the same view. Here's some examples. You probably don't need to read these ESG factors. So pollution, right? Everyone's interested in preventing pollution. In fact, I don't know anyone who's pro-pollution. Energy efficiency, this is super important. Reduced emissions, and then safety and regulatory standards. So those should make perfect sense. But let's go ahead and answer the question that asks us, all right, we know that we're in favor of handling and managing all of these ESG factors, but what does that do when it comes down to finding, what's our job as financial analysts, right? We're trying to find undervalued and overvalued securities. So let's go ahead and look at some investment strategies. All right, sustainable investing. What does this mean? This involves factoring in sustainable issues while investing. So some shareholders have sustainability issues that are related to pollution. Some investors have sustainability issues that are related to some other factors, maybe social justice or other issues out there. And so that comes in to social responsible investment, which includes promoting a positive environmental and social kind of an outcome. So maximize shareholder wealth, while promoting positive environmental and social attributes. There are thematic investments so that you can look at assets and asset classes related to ESG factors. And of course, you can screen corporations. You can rank them, and you can order them, and you can decide what is the level at which you're comfortable making this recommendation, on a scale of 1 to 10. Do we want to say, well, we're not going to invest in a company unless it scores a 10? And then we'll say, well, then maybe there are no companies out there that score a 10. So then we're in trouble, right? It's our job to find financial assets for our clients. Well, if there are none, well, that doesn't make any sense. So maybe we'll say a 7 or a 6, whatever that number is. And so there are, of course, screening tools that you can do this. And then impact investing as well. So here are the screening tools. So negative screening, this excludes. Positive screening would include. And then the best in class approach. And Morgan Stanley has some of these ratings out there. And so you rank these and you can decide where you feel comfortable investing. Now, that thematic investing, of course, focuses on probably a single factor or maybe a handful of factors like energy efficiency or maybe climate change. And then impact investing, and then engagement and active ownership. And that takes us through our 2 slide decks here for learning outcome statements. I think there are tons and tons of really good exam questions here. But think about this. If you understand my concept of the silos and the co-riskiness between all of those, and the responsibility of the chief risk officer, even though that's not part of this reading, but as the chief risk officer, as part of the executive leadership team, which is a focal point of this particular reading, and how it relates to the board of directors and each responsibility, I think you'll be able to answer these questions.